The biggest objection, the biggest struggle with mortgage protection leads in the digital and mailer game is going to be equity protection. In this video, I'm going to be breaking down how you can pitch concepts rather than numbers and why that's going to help increase your close rate significantly. My name's Trey. I'm the owner of Agent Lead Lab. In the past 3.5 years, we've helped 550 agents issue pay $40,000 per month. And on this channel, I talk about the methods, strategies, and behaviors of those individuals that have worked with us, as well as strategies that you can go out and implement. So as always, please make sure to like, comment, and subscribe. Let's hop right into the video. Cool. So today I want to talk about equity protection, pitching it, what that means. So first, we'll start off with most people think that selling mortgage protection is selling term, and that is not true, right? It's not true about mortgage protection. And I want to explain that, and let's talk about why that's not true. Because I think me just telling you that you're going to be selling a lot of more equity protection is like, oh, Trey, like you're just saying that. I need you to understand why you're not selling a lot of term, but rather you're selling equity. So why you're not selling term, but selling equity. Okay. Now, think about this. First, we'll start with the platform. Okay. So, from a platform standpoint, we're talking about Facebook, Instagram, Google, LinkedIn. Like paid advertising traffic tends to be older individuals, relatively speaking, who are typically clicking on these forums looking for life insurance products. Now, take a step back, okay? Think about our parents, think about ourselves, right? I always try to think from the frame of like, what would I do? What would my consumer behavior? If I saw an ad about life insurance, I'm not gonna fill the ad out to somebody when I could go like down the street to State Farm or like call a friend or family member. And if I don't know anybody, I'm probably not gonna use the ad to go ahead and figure that out. Who are going to be the people who do that, right? I talk a lot about demographic behaviors and how you can think through your clients so that way you as an agent can have proper expectations. But platform is number one. You're going to be getting older people. Okay. So inherently, they're not even going to qualify for a lot of these term products. If they're 65, 67, 68, 70, 70 and above, like most carriers aren't going to give them a 15 or 20-year term. Right. And if you don't understand that, you need to talk to your upline and kind of break down why those numbers are. And you should also have an understanding of like carrier rates. I think one of the things that's underrated in this game, very side note, let me pull up the big screen here. One of the things that's extremely underrated in this game is the fact that you do not need to be a student. I think it's pure ignorance. I don't like it at all. I think that you need to be a student to understand not only who you're serving, but the products that you're offering. Now, I'm not saying that you need to be a wizard nut and like spend all day and not go out and take action. No, take action first. But if you've been working in this industry for more than like a week, even through the night, like you should call your leads. Don't wait to figure it all out because that's dumb. Take action first. Start there. But once you start taking action in your spare time, you should be looking things up. Like one of my biggest regrets personally, I'll be transparent, that I did not do as an agent. And honestly, I knew better, but I just didn't take the time to do it. Number one, because I just didn't take the time to do it. So I'm going to take accountability. Number two, one of the main drivers was that, football has always been my main thing. So even when I was selling, I was waking up, going to the gym, booking appointments. I still had to do like training in the middle of the day sometimes. And then I would come back and drive. So like I was literally just making enough money to get by. I was not doing the business the right way. But what you can do if you're watching this, because more than likely, no disrespect, you're probably not in the NFL, and this is all you do, is study the game. Okay, one of the best salespeople that I've been around, won't drop his name, was in my upline, absolute savage. Talked about how he used to study, right, the process of probate. He used to understand and know everything that had to do with loans, rates, what happens if somebody dies, how long it will take for like he spent a long time doing that. Why? Because when he spoke to people, he was the master. He was the advisor. I listened to one of my agents yesterday. What happens is sometimes when these people fill out ads, the number goes to my business number, which is associated to the page because I have to have all the compliance stuff. It redirects to my phone. So occasionally I'll get like a call. I love them though. I'll get the call and then I'll just like transfer to one of my guys and just let them close it. So I was just sitting there on mute and I was listening to him explain the process that veterans go through and what they perceive that they're getting at life insurance and what it actually is. And obviously I knew that, but listening to him say it really opened up my eyes to like, wow, how many agents aren't doing this? Because sometimes I've transferred the calls to other agents and they don't do this, right? And I think that without you really knowing and being a true expert, you are shortchanging not only the client but yourself and the potential income that you're leaving on the table. So I want to start there. I just had to go on a quick tangent because I think that's super, super important that you have to understand that. Now, the platform is going to bring you older people. Just, I don't care what anybody says. It's going to lean towards that when it comes to like age. There are ways to mitigate that and get lower age clients, but neither here nor there. This is my stuff is not if you just work with me. This is if you're an agent working with anybody. So I want to help. So that way you can figure out ways so you can start selling more. So platform is going to be huge. And even when you're getting mailers, like you're not going to get 20 and 30-year-olds all the time. You will get, 40, 50, 60-year-olds, but like you're going to have 60-year-olds and 70-year-olds that mail back and they're going to charge you $90. So the question then is like, okay, so we talked about the platform. Okay, so it doesn't make sense for them to get a term because a 15-year term on a 70-year-old is 85. And guess what's going to happen when they probably will out of that is like they're going to have to apply for insurance again. So the reason why equity protection is so big, and this is where I'm going to spend most of my time, and before I get into like how to pitch it, but I'm going to talk a lot about like why it's so important to sell. So think about honestly, for me, it's like 50 and above, I was selling equity. And I know it sounds crazy, but like that's how I was selling it. And I'd sell big whole life policies. Sometimes if they're like at 50, cool. But if they're like 55, 60, I'm still selling equity. And I'm going to explain why. And I'm not saying that you have to do this, but I personally felt better about it. So when you sell a term policy, and I forget all the stats, I used to know them, but essentially like the reason why they sell term is because people outlive the term, right? If they did not live the term, they wouldn't sell it because then they wouldn't have business. So already from the jump, it makes sense. Okay. Like you buy a term because they tell you, oh, I protect all this stuff. And then you outlive the term, you have to apply for insurance. That's why all these final expense clients typically a lot of these people had term policies before. And now they're 70, 80, 85 years old looking for life insurance and they can't get it because they don't have any. And it's like, well, you had all these term policies because it made you feel good. But in reality, you never died within the term. So then you didn't really do it. That's why even if you're super healthy and you're like 70, they still might give you a term. And you're like, oh my goodness. And it's like, yeah, dude, because they're betting that you're probably going to live. And if you live, then they're more likely to not have to pay. And then guess what? You have to rebuy more insurance later. And they're going to charge you out the wazoo and take their chances. Right? So as an agent, you need to know this because you need to be able to explain that to your clients. You also need to explain to them why, if they're 60 and above, equity is a better option. And here's why I believe so. This is why I love the mortgage protection. Okay, so you're talking to John. He's 30 years old with a $500,000 mortgage. So let's do $250,000 mortgage. You could say, John, we're going to get you, and this is the numbers and the pitches I'm going to explain in a second. But let's just start here with why equity protection is a better option for John, who's 60, who has a $250,000 mortgage. Now you can say, John, I can get you $250,000 of term insurance. Okay, it's going to be $318 a month. Okay, it's going to cover this, do this, do this, do this, do this. But you know that if John's getting approved, which if you did your financial inventory at the beginning, you asked the proper questions and you have a pretty general assumption, you probably pushed him a little bit through MIB, you should kind of already know where he lies. And if you do, and he's relatively healthy, and this is the stat I was going to say, I think it says XYZ amount of people outlive their term. He's probably going to outlive his term, which then means that if he outlives his term, he's going to have to reapply for life insurance at 75. And if you know anything about rates, they go up based off of your age and your health. So if he has any health conditions, which he probably will, doesn't have to be crazy, it can already start affecting his rating. If he has guaranteed issue, right? If it's standard, he's going to have a 2-year wait period, which would be a guaranteed issue. That's my bad, but graded. I apologize. So regardless of how you look at it, the likelihood that he passes away is kind of slim because he's healthy, but also the likelihood that he gets some sort of medication or diagnosis over the next 15 years is also increased. So therefore, in 15 years, his rate would be better. Now, if you're an agent and you're like, I'm gonna just make my sell and get my 315, like I'm not gonna say I haven't been there. I'm gonna be honest, like I'd be lying if I said that. But as I learned, in reality, like you could also reverse engineer that same picture. Like, John, you're super healthy. You're probably gonna outlive this. And not only that, you don't have any other life insurance. What if we actually put together a strategy, right, where we were able to save you some money? Also, we were able to protect the equity in the home, which you've already told me that your wife is going to leave when she passes away, right? Right. So, like, okay, well, then we don't need to cut a mortgage because that doesn't really make sense. So, we can do what's called equity payments. It's going to be significantly less for you, right, per month. And it's going to build a little bit of cash value, right? So, it's going to act like a glorified savings account. And here's the best part. when you turn 75, it's still there. So you're gonna have this big wad of cash that you can hand over to your wife or to your kids or to your grandkids, and you never have to worry about insurance ever again. This will be the last time you ever talk to anybody. You want to fill out any forms. So when you say it like how I just did, with obviously all the value that you provided on the front end of the call, you are going to close more because now you are, which will we're transitioning into the numbers, but that's the truth. Like you're actually putting, like it is going to grow with a little bit of cash value. It's not going to be an IUL. It's not going to be crazy. Might be a few percentage. Fine. It's going to work better than a savings account. Fine. They're going to get approved immediately. Fine. They're going to have a standard rate and it's going to be lifetime. Fine. It will be there when they're freaking 90. Fine. Like, dude, all of the things that like you are basically setting, and then you already said she's going to pass. So if she passes, here's what's going to happen. You're going to take the money, pay the house off, and then sell the house to get the same money back. That makes no sense. And you're going to spend all this money now, and it's like you're just betting on dying. I'm not doing that. Why don't we just put together a plan, John? Let me pull up some options for you. And then you pull up some options, and you look at, let's say his mortgage is $5,000 a month. You're like, John, we just need 6 to 12 months of equity protection, I personally think, and then you just downsell them. So then you tell, like, and this, now that I've said that part, let me hop into the pitch. I'm just going now. So here's how you look at pitching numbers versus pitching solutions. I had a gentleman that doesn't even run my leads. I'm genuine. Watched my YouTube videos, was like, yo, Trey, I called me up. I met him through somewhere. And he called me up and he was like, yo, let me just go through these numbers with you. I want to talk about them. I'm like, all right, cool. Well, let's touch base. So we went through his numbers really quickly. And then he was asking me some questions. And I'm like, dude, why don't you just pitch your middle? We figured out he needs to pitch $60 more per pitch in order to increase his collected per premium is at like 800 in deposits. And I was like, dude, if we can just get it to 1200 or whatever it was, I forget what the numbers. Basically, he had to sell. To give you an example, let's say he's closing and he's getting $1,000 in his like issue paid, so into his bank account. He wants to hit 40K, right? And he was like, well, I could spend all this other stuff. And I was like, well, what if we just take it from 1,000 to 1,500? And I was like, okay, well, $500 more is just $60 a month because 60 times 12 is 500, right? So like if we can issue out an extra six, I was like, dude, you can find $60 worth of value in every close to associate that with your pitches. I was like, how are you pitching? He told me his options. Like, well, they're always picking the lowest options. I was like, yeah, dude, because the way you're pitching. And I was like, well, he's like, well, sometimes I pick the middle. And I'm like, okay, well, what are you saying? And we kind of went through it. And it was like, he's just pitching, like he's closing, but his lowest option is like real low. And I was like, bro, I've been betting, man, that those people have an extra $60. Now, the way you can do it is like, don't just over pitch them, but if you pitch them options that go 1, 2, 3, you're going to make more because that lowest option that you're pitching is actually going to be the option that you want them to take. You're being genuine. You're telling, if they want to pick the middle one, cool. You can associate the budget. They feel like you're not selling them because you're actually telling them, hey, John, like honestly, based on your situation, let's start here. We can always add more coverage. Let's go ahead and get you approved and move forward. Because typically what happens is when people close a lot of deals, but they have low premium, it just means that they're pitching people too low of options. Because like people have more money to put towards, like, especially with mortgage protection. I can't speak for like final expense. And IUL is hit or miss depending on how it's set up. But if you're doing like final mortgage protection or like veteran and you're closing at a low clip, that has everything to do with just your sales skill. It has nothing to do with the leads or anything because those demographics have the money. It's not that they don't have the money. Like final expense don't have the money. So you got to go more volume, right? So your cost to acquire clients should be super low, but also like your collected per sale should also be relatively like kind of low because they don't have a lot of money. Like if you're dealing with a homeowner and they're paying $5,000 a month in their mortgage, like bro, they have $250 disposable that they can like throw somewhere. It's not gonna like kill them. So what I told him to do is just increase his lowest option to $60 more. And literally this past week, he was like, bro, he literally texted me. He was like, bro, I've literally closed 13K this week. Like I've never closed that much off of one simple thing. I don't get any credit for it. I'm not trying to get credit. And bro, if you watch it, kudos to you, bro. I do this for the love. Like I said, like all the stuff that we do for our clients, all that stuff's complimentary. And he's not even a client. You feel me? Like, so we don't even charge for, that type of stuff. The reason why I'm saying that is that's kind of what made me think about recording this video. And the gentleman I spoke to yesterday, which is like when you pitch numbers, right? So I'll give you an example. Okay. So a number would be this. Let me kind of show you what I'm thinking through. So pitching numbers would be, so pitching numbers. This is what that would be. So this would be like, John, You have three options. And I like writing stuff out, but I'm just gonna type it for the sake of me going through the example. So option one, people will be like, you have the gold, silver, bronze. This is the problem. This is why people don't sell a lot because they just give three options. They're like, John, let's say this person is doing equity or they're doing term, but I suggest equity, so we're going to focus on. John, we've got, option one. That's going to be, and by the way, let's say his mortgage is what's it? So 369. So John's 15,000, right? It's going to be 3 months of mortgage payments. This is how most agents pitch. Option two, it'll be 6 options, so 5, so 30,000. So 6 months mortgage payment. And then option three is 9 months. So 9 times 5, 45,000 per month payments. And they're like, John, each of these are blah, 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 blah. How much, which one do you want? This is how like most people pitch. Doesn't matter what product it is. If it's an IUL, they're like, hey, we have 150 or 200 or 100 or 300. And like in some cases, yes, this works. And there's some demographics that it doesn't, especially how straightforward they are. Like veterans, they're a little bit more straightforward. So you don't need to do a lot of stuff, but you do need to still figure out their why. Now, the reason why this doesn't work well with closing and you close for a lot more and you close less is because there's no value. A lot of times people ask, like, we've been trained to say, well, ask why they want it and then just use that. And it's like, bro, no. You ask why somebody wants something because you want to actually solve a problem. Like if I say to me, 3, 6, and 9 means nothing. Like for me, I'd be like, well, I just take 3, or I just take 6. Like I'm just picking. No, I guess I have $200. Like there's nothing here. So like what you should do is at the beginning of the call, you should have asked a ton of questions that figured out like what does John need? Like when John passes, what happens? John, when you die, explain to me vividly what's going to happen. Well, okay, John, look, I'm the licensed advisor. I need you to explain this to me so I can actually put you in the best situation. So when you die, John, okay, your wife's name is Susie. Okay, so Susie, is Susie working? Yes. Okay, so if you die, take us back, John. How much are you making per month? I'm making, $6,000. Okay, so I'm gonna walk you through how I do it. So I'd be like, John, how much are you making? What are you looking to do? John's like, he's gonna be like, protect my wife and pay off my mortgage. Okay, that's perfect. Cool. Thanks, John. So, John, if you pass away, what happens? Oh man, well, I need she won't be able to take care of it. Cool, John. So let's make it really vivid. Because today, what I'm gonna do for you, John, is I'm actually going to put together a strategic plan for you and your family. So, I'm not sure if you ever met. Have you ever met with any other licensed advisors? Yes. Cool. Well, a lot of people, correct me if I'm wrong, in your previous experience, where they just kind of giving you quotes. He's like, yeah. He's like, I'm not the quote guy. Okay. My job is to solve problems and to actually help you put something together and also to get you approved. All right. But before we can do all of that stuff, I need to, I'm going to be the person that's going to be there for Susie in the event that, you do pass. So that way, right, she can call me and she knows what to do with the money. Because the way this works, John, is whatever we get approved for, they're going to send you a tax-free death benefit, and I'll be delivering a check or however you want to verbalize it to you. And then we're going to leverage whatever money we have towards whatever it is. It does not like go directly towards your mortgage. Does that make sense? Like, yeah, most people don't know that. Okay. So then I have to explain that to them. So the reason why I'm saying that, John, is because we need to figure out what to do with the money. I'm not just going to tell you, let's get $300,000 because well, that's right now, John. But if in 7 years you pass and we still get $300,000, do we just I'm not saying we can't hand it over to your wife, but at least we should have a strategy to know what to do with it, right? Like that would make sense. You would want to know, like, if you're gone, what's going on with the money that you put into this policy, correct? And he's going to say yes. You say, okay, perfect. You say, John, all right, protect your wife. Wife is Susie. All right, so John, just so I can understanding, what are you doing for work, John? I'm a carpenter. Perfect. And then just ballpark, John, what are you bringing in like per month? Making like 8,000. Oh, that's great, man. Sounds good, man. Super, super, congratulations on that. You're doing really well for yourself. Now, you mentioned Susie. Okay. Now, what is Susie doing? Oh, she's a nurse. What does Susie make? Susie makes $5,000. Okay, perfect. Cool. So sounds good. So she's making about $5,000. You're making that. So together, just correct me if I'm wrong, you guys are both bringing in about 13,000. Is that correct? He's like, yes. It's like, oh, perfect. So really your biggest focus was to make sure that something happened. Cool. So just so I have clarity here, John, what is your monthly mortgage payment? It's like, well, it's 5 grand. So okay, well, is it 5 grand after like taxes, interest, all the other things? And he's like, no, it's 5,500. Just making this up, okay? And these numbers could obviously be lower, so just go with me, guys. Like you're gonna associate this based on your situation. Perfect, John. So now you start assuming, John. So I'm assuming, based off of what I've just seen thus far, we haven't even gone that deep, that if something happened to you, John, you're looking to make sure that this mortgage can be taken care of because Susie can't even, theoretically afford to pay for the mortgage with her income. Am I understanding that correctly? He's going to say yes. It's like, perfect. So now you've already started painting the picture. So you explain to John, like, okay, cool, John, sounds good. So it sounds like we definitely need to figure out something to do. Worst case scenario, to at least be able to cover those mortgage payments. See, I'm saying words. People are like, well, how do I get to equity protection? I just want to cover the house. I'm like, dude, because you're just going in and being like, we're going to cover your mortgage. You're not digging deep in the why. When you dig deep in the why and you figure out what the real problems are, you can solve them. Okay, so you say, perfect. John, so I see why we needed to do this because at least worst case scenario, John, we need to make sure that Susie can cover mortgage payments because if you pass, she can't cover that right now. So I understand that's what the main thing we're looking into, and that's what it sounds like we're going to be looking into. Okay, so or I know it was a bad word track, but you guys get the point. Cool. He says yes. You say, okay, John, so that makes total sense to me. Now, as far as budget goes, let's just currently, because I understand why we're here. And I mean, do you have any other kids, John? And let's, for the sake of example, say no, they don't have any kids. If they did, you would go through and say like, okay, what does it look like for Susie? Paint that picture, right? Well, Susie, will you still live here? No, I'd probably move. Okay, cool. So you, like, in the event that John does pass, right? Like you're moving, right? You guys have, 3 bedroom or 4 bedrooms, whatever. He's gone. Like you don't want to. Nah, I'd probably move, go to my sister's crib. Like, dude, you got to spend time. People just want to hop into it. I'm trying to paint the picture. Why? Because it's an emotional and logical sale. The emotional to me is just to gather the information, but I'm closing on logic because to me, the way I look at it is the emotional part comes out at the beginning to get the numbers. Right? Numbers is logic, but I use emotion to draw numbers. Don, what happens if you pass away? This is obviously clear because she doesn't have enough money, so we need to break this down. So I'm getting all the numbers. Now I say, okay, let's do mortgage payment. And then eventually I ask a few more questions for the sake of time. I'm not going to go through every question, but think about this. Another side note I've told people before is like when you're running leads, you should, to get really good at this part, I sucked at it. I heard one of my mentors say he would walk in a house with a G-Shock and turn on the 10-minute timer. And when they turn on a 10-minute timer, he give himself 10 minutes to ask as many questions. He could not move into anything. No financial inventory, no nothing until he asked enough questions. He would just sit there and it was awkward, but it made him learn in the heat of the fire how to ask the right questions. And actually like the frame he uses, like just care about them as if they were your family and you had to figure out how can I help them. And that's it. And you can't help them unless you understand their situation. So you say, John, perfect, sounds good. So this is how much you have, this is how much the mortgage payment is. And they're gonna say, okay, sounds good. So John, let's break down your budget. And then you're gonna go into the budget and say, okay, so you're making 8. Sorry, y'all. My nose is itching. You're making 8, she's making 5. So you have 13 together. So you cover the mortgage. So essentially when you do cover the mortgage, you have basically the 8K left, right? You start breaking things down. It's like, okay, do you have a car? Yes. And the reason why you do budget, an actual budget assessment, is because you need to figure out what options to show them. Now, some people will get backlash here because they'll be like, well, they just want a quote. And it's like, okay, well, I can throw out any number, but that doesn't matter. You can go to ChatGPT and look at numbers. All right, let me tell you what a number is. 50 to 200 bucks. Does that make you feel good? Or do you actually want to put something in place for your family? And if they say, I just want to look at numbers, I don't care about protecting my family, bro, hang up the phone. That's not even somebody you want to talk to. It's not even worth trying to push that through because that doesn't make them that doesn't make it a bad lead. That just means like, dude, they have no associative value. And that's okay because everybody's not going to be a close and everybody's not going to be the right fit. And if you do try to push too many people through, you will have chargeback. Because if they tell you they don't want it, but you're just pushing them, that's not the place you want to be, right? So budget is one of those things that you need to spend time on, right? Because you need to spend time on what it looks like when you pass, okay? And you also need to figure out like and this to me, budget is like where you press on emotion. Budget is emotion. The first part is logical because you're going to use the first part in sales. You don't really use the budget when you close. You use the budget to figure out how much they have left, to pitch them options, and plans that fit it. So let's say you go through everything, but like Netflix, you go through the car payments. I'd ask them, so, hey, can you break your budget down? What are you guys spending on cars? What do you guys spend on groceries? What do you guys typically get? And because they'll tell you like, well, how much is it? It's like, bro, how much do you have left? So let's say if you do have all this stuff, you break down everything. These people have, $3,000 left in disposable income. Let's just say they have $3,000 left, and that'd be kind of high. But let's just know that's pretty high. Let's say they have like $1,500 left in disposable income at the end of every month, and then they take about $500 put it into investments. So they got about $1,000 left after you broke everything down. Okay. Now, this is where you start figuring out how to use the money, but also how to make the money make sense for their situation. Okay. So when you don't so when you get down to the end, you get a number for yourself. Then you ask them, John, so after we broke everything down, just so I'm clear, between you and Susie, you guys typically have about $1,000 left that you can just play with. Is that correct? And I'm talking about everything. And that I'm asking them, like, what do you put away for travel, for future travel? Do you have an emergency fund? What are you putting in investments? What are you putting in savings? Let's just say that even if this was like, no, actually, we put another, $500 a month into a joint savings account. Cool. So you have $500 left. So now I know what the real number is. Now that I know the real number, I can actually help, right? I can actually help. Now, there's a few different things. In this example I gave you earlier of this $250,000 mortgage that they have, which, by the way, would be crazy based on those payments, but just roll with me for the sake of it. They have $500 left to use, right? This is called finding the money. That's what this concept is, where you break all down the budget. All right. Now, outside of that, what you need to realize is that in those three options that you have, okay, so 15, 30, and 45 that you pitched in the bad version, you're just throwing out numbers, right? Even if you did do this part, you're literally throwing out numbers. So you don't want to throw out numbers. You want to throw out value associated with it. Now, you should have painted the picture of what happens when John passes for Susie, okay? When it comes to the close, after you've done all that, you're like, perfect, sounds good. I understand kind of what your budget is. Now, my job is, let me ask a few questions to figure out where you're at, right? And now you're moving into like the MIB. Now, I personally, when I sold, there's another reason why I liked equity. There's carriers that do a lot of stuff. One of the carriers that I used was a final expense company that I would use, and I could actually fill out part of their MIB. I could do the MIB and it'll tell me what they get qualified before I pitch numbers. So I knew exactly what they were going to get approved. And then I could just say with conviction, like, these are the options. So what I would do is I would start asking questions and say, hey, so I don't waste your time. One of the things we do have to do is make sure that you could even get qualified for this. So I can show you plans that you actually get. Right. So here's kind of the process I'd go through and I'd give them that. Now, sometimes I would do that. Sometimes I wouldn't. I would lean on the side of doing it. But if you don't have the carrier, you don't have to. But you still need to ask the questions and you should know what they should get approved for. So you should have a cheat sheet, or you should call your upline after you figure out and ask them some simple questions what they could get approved for. And they'll tell you the company to use. And then you pull up the quotes that they might get approved for. Right? And then you proceed forward with the application. So there's two ways you can do it. Most people won't have, I don't even think that carrier's around anymore. Most people won't have the carriers that can give them like a pre-approval MIB. I got like a soft pull. Think about it if it was credit, right? Most people don't have that carrier. So the way I look at it is this. Now that you have asked them their questions, you know that, let's just say they're going to get standard. Okay, so now this is when we get to the gritty. When you go to look at the options, the way you associate the options is this. This is how I do the closes for equity. Okay. I'm always looking at a few things. There's really only three things. I talked about this in one of my videos. That this is why I love mortgage protection. Okay. Number one is going to be supplemental income. This basically just means we take how much the person who's passing has and we apply that to 3, 6, and 9. Okay. That's number one. So you have supplemental income, close. You have your final expenses, right? This is if you're doing equity. This is how I close equity. This is why I like equity for what's it called? Because it's whole life. So you can save final expenses for term, but it's hard because if they don't pass, you can't use it. Okay, final expenses. Then you have mortgage payments. And then you also have a bonus. So I'm going to call this a bonus, which in my opinion is going to be miscellaneous items, events, purchases, and pain points. Okay, so let me go through this. Supplemental income would be Susie. I'll show you, like, you're giving Susie 3 months of supplemental income. Okay. Final expenses is you're providing $10, $15, $20, $30,000 for burial cremation, which you would ask them when they pass away, how do they want to be set up? And they'll tell you. So you can put an actual number to it. And then mortgage payments is obviously you just multiply how much the mortgage costs with obviously all the interest and fees times 3, 6, or 9. So I always did 3, 6, or 9. I didn't go past that because to me, if you're pitching equity for more than 12 months, then you're probably just pitching equity. And that's not valuable enough. Because once again, if you pitch the same thing, 3, 6, 9, that doesn't matter. So here's what this looks like. Let me show you how I would explain to John. John, we've got 3 options. Goodness. John, we've got 3 options. Okay. Option 1, and I would give them names, right? It's like basic, standard, and then elite. All right. So we have 3 different options that I think would be best for you and Susie. All right. I'm going to start with the elite option. Okay. So this is what this is. Currently, John, and I would have already explained to him what equity protection is, right? I'm not going to go here into the pitch and now all of a sudden spark on them the numbers, the price, and all that. It's way too much. I would have already explained to him why we're not going to do. I would have showed him, hey, this is what 250,000. Let's look at some options. Let me show you. I would have just showed him one option. I wouldn't have showed him 3 because I want to be in control. Because I want him to get equity. That's what I want him to get. Because number 1, he's going to get approved for it. Number 2, it's better for him. Number 3, it's really solid for me too. Like everybody wins. And he gets it for less. And he's going to like it. And I'm going to show him all 3 options that start with whatever he was going to get for term and work backwards. So I would say, bro, I don't know why my nose is itching, but this is like bugging me, dog. Okay, so I'd say elite option. All right. So this package is going to be the same amount. All right, John, it's going to be $315. So let's start there. All right, but here's what that $315 is going to do. This is going to get us, let's say, I'm just going to make this up. It's going to be $50,000 of equity protection, which is essentially going to be 10 months of mortgage payments. I'm just making this up right now, okay? Plus, it's going to provide supplemental income. Sorry, my bad. I did this wrong. Apologize. So there's going to be $50,000. I'm so sorry. $315, John. What this is going to be is this will be, I'm going to say, 12 months of mortgage payments plus 3 months of supplemental income replacement, which would be an extra, the $15,000, and then plus $20,000 burial. I'm making this up as I go because I don't actually have the numbers, but just vibe with me for a second. Let's say it was, this is kind of unrealistic because these wouldn't be the numbers for like a 60-year-old, but what I'm trying to get at is you would say how much is going to be for the mortgage payments. So let's make it a little bit more realistic. Let's go 6 months of mortgage payments. So that's $30K. Let's do 3 months of supplemental income. So that's $15K. So that's $45K. And then let's say that he wanted to be cremated. So we'll just say $10,000 in burial because I use this to know the number. Well, it doesn't even matter actually. Yeah, let's just do this. Let's say this option number 1, because I would pitch really high, like $550. Okay. So that would be this one, $550 a month. So 6 months mortgage payments, 3 months supplemental income, plus $20,000 burial plan. Right. So that's going to be option 1. Okay. Now, John, here's going to be the standard package. Now, this is what most of my clients end up doing here, John. All right. So this option is going to be $350. Okay. It's going to be right around the same that you were spending before, but it's gonna provide us with a few things based off of what we said. Okay. So now it's going to be 6 months mortgage payments to make sure that she can move, plus $20,000 towards burial. Okay. And then the basic package. This is personally what I recommend for you, John, because in this situation, you've already mentioned that, she's going to move. She'll have all the additional funds to also sell the house. And in the event that you do outlive the policy, which you are extremely healthy, and it's very likely that you do, she'll have essentially $30,000 of, life insurance to make sure that you're buried too, right? Or $20,000 of life insurance to make sure that you're buried. So in this instance, John, this option is actually only going to be $205. Okay, so here's what that looks like. That's going to be $20,000 broken down into 3 months mortgage payments plus, let's call it 25,000. I'm just trying to make these numbers up, but I would be writing this out. 25,000 broken into 3 months of mortgage payments. That's 5 times 3 is 15. Yeah, plus $10,000 for no. Yeah, my bad. This I was right the first time. Let's say it's $20,000. So I'll be 4 months mortgage payments plus the equity in the home, right? And the reason why you do this is I've already explained this to them, right? That like we're getting this mortgage payments, but we're also selling the home. So theoretically, we're getting for $20,000 of life insurance, but also we're going to be able to take the equity in the home. Which if it's a $280,000 home, you have XYZ equity in it. We add that to it, and you give them the total number. So let's say it had you could resell the home for $500K, right? So you would be making like an extra, $300,000 after you pay for the life insurance and you resold the home. So you're actually paying for $205, but you're getting $300,000 in guaranteed return in the event that you pass. And if you don't pass, then you take the $20,000, you can put it towards your end of life expenses. And that's how I would pitch it. And I know this was kind of all over the place because this is live and like I'm literally freestyling off the top of my head. But in a real life situation, I would have written all this down and came up with an actual strategic game plan. But this is how you pitch, right? Like these are, you associate the numbers with something. You don't just say 3 months, 6 months, 9 months, or 12, 16, 24. Like that's cool. But like you're never going to write high premiums. Like, see, with this, if you were doing that, it's like, well, $20,000, $35,000, and $50,000 of whole life equity protection is like 369. There's nothing there. You have to take stuff away as you go. So when I say here, the 3 closes are here. You do one that is just mortgage payments. You do one that's mortgage payments and final expenses. You do one that's mortgage payments, final expenses, and supplemental income. So this one is always 3. Then you go 2. Then you go 1. That's how you do it every single time. You don't change it. It's the SOP. 3, 2, 1. 3, 2, 1. Now, occasionally, you can go 4, 3, 2 if they have something else. So let's say that in this situation, they have a daughter who they want to leave behind, $10,000 for whatever, for their grandkids or something. Then it's like, cool, you show them option 1 is like $600 or even the same price. And you make the prices where the first price you never want them to buy. The second and first price are typically the ones you want them to stay in. Because you could always provide the value of like, that's too much. I know that you probably want that, but let's look at this. We can always upgrade. And they feel like you're doing them a favor. That's like the most effective way to be able to leverage it. So when you understand that, you pitch the options based off of exactly what it is they need. And some people will tell you like they don't want to be buried in cremation. So you have to pivot these things, but these are the different things that you close them on to associate to the value. And I did the same thing for final expense, and I didn't really sell IULs, but I'm sure I would find a way to do the same thing with IULs. Because when you close, you need to close on the value that they're getting. Because if you're just closing on numbers, that means absolutely nothing. You got to close on what the numbers do. And then they're like, oh, so I'm paying $350 for 6 months of mortgage payments plus the ability for me to have my funeral and final expense taken care of. And in the event that I don't pass away, then now those 3 months of mortgage payments, I actually have $50,000 of whole life coverage that I can leave behind to my family. And that means $20,000 I can go towards burial, another $30K that I can leave to my grandkids or just to my spouse as additional supplemental income. So the cool thing is when you explain these concepts, you tell them, hey, equity protection, you tell them what supplemental income is, and then obviously they know what final expenses are. So when you pitch them, they know what to do with the money because it's not buying life insurance for the thing. It's buying life insurance for whatever you associate the life insurance to be useful for. And if you can explain to your client how it works, they're more likely to keep it and less likely to charge back. Because when another agent calls and they're like, yeah, dude, we're going to come and like do this and replace your policy. You can't replace my policy because even if you come with a cheaper price, they can't make it make sense from an image perspective. And because of that, like there's no way that they can beat you. Like it's just not going to happen. It won't happen. So I hope this helps. Sorry that my nose is itching today. I don't actually know why. And it actually is kind of frustrating me. But regardless, I hope this made sense. This might have been a little much, but trust me, this is why people struggle with mortgage protection. It's not because the leads are bad. It's not because mortgage protection is hard or is not simple. It is simple, but it's just people won't take the time to figure this stuff out or care enough. Other lead types you can just pitch options and close. This you really, really got to lock in. You really got to be able to associate true value and find the money to pitch them in options. Because once again, this is outside their budget. So I would say this is our elite package, but it's outside your budget. This is a little bit below, but this is probably perfect, right? This is half the less money that they have left to use, right? And if you want to go lower, you could. You could even go like 180 a month. Because here's the best thing: if you take 180 and multiply it times 12, you're still getting $2,100. So you could go even lower. Like you could go lower. That's why it's like I never wrote anything low, because like 205 times 12 is 2,400. Like you're walking out the door with $2,400 with real value associated with it. In worst case scenario, you're walking out with even less value. But I'll tell you what, the person who's probably slinging, $1,000 or $1,100 in mortgage, I know for a fact they're not providing no value. They're not associating those mortgage payments with anything. They can't be, or else they'd be selling more, because it's impossible. Like that only happens when you just show them basic options. You just throw out numbers that have no relevance. I throw out numbers that mean something. These are the only three things they need: supplemental income, cover the final expenses, mortgage payments. Now, bonus could be pain points, investments, stuff like that. That's advanced though. Just to start to make average 2K per sale, all you gotta do is this right here. When we were selling it and I was part of our agency, I think our average annual premium was like 2,300 or something like that across the entire agency. Like we were crushing it. Absolutely crushing it. So as always, please make sure that you like, comment, subscribe. I gotta figure this nose situation out, so I am sorry. You can go to leadlabcrm.com, book a call, speak with our team, or you can go to agentleadlab.com to book a call, speak to our team, and you can go to Lead Lab CRM if you'd like to try out some of our leads. As always, please make sure that you like, comment, subscribe. I'll see you guys next time. Peace.